as I said before, that I wanted to take you through something. Have you done shares with your teacher at school?
Pardon?
Have you done shares at school?
You mean like
Ordinary shares,
Nzwang?
ordinary shares, share capital,
Yeah,
share
share
buyback.
capital, dividends, and ordinary shares, and all that other things.
Yes.
Yeah, that's what we're doing currently.
Okay, how are you feeling about that?
Yeah, it's understandable. Like it's yeah, I understand that topic. Kind of.
Okay. Yeah, I also wanted us to touch on it myself, so that we can maybe move on once I'm done with it. That's part of bookkeeping of companies. You know, when the company is being incorporated, or when the company is being started or created, we need capital. Every business, when you start a business, we need capital, right? And because of that, and for the fact that the company is not just owned by one person, it belongs to a couple of people, which is shareholders. They have to buy shares for the company to be started or to be created. They have to buy shares, and by buying those shares, they raising capital for the business to start operating. I think that's the main issue that I want us to deal with today. So we're going to look at the bookkeeping of companies. We're talking about ordinary shares. We're talking about the share capital note, number 7, the authorized shares. We need to understand what is that. We need to understand shares that have been issued during the year. We need to understand about shares that have been bought back. Those are the things that I think I want us to touch on right now. Okay. I have these notes. I sent this note to your email. Please look at it whenever we're done. It's just the theory parts that I want you guys to look at before we even go to finalize the question that we're doing, because we needed to touch on a few things here to finish these two transactions. They're touching dividends, they're touching shares, of which something that I wanted us to talk about. Okay. Therefore, I'm going to go back to this note. Hi, Kinelwe.
Hi.
How are you? Are you okay, Kinelwe?
Pardon?
Are you good?
Good, and you, sir?
Good, thanks. Okay, guys, let's start here. We're going to do this thing. I was explaining to Smanga here that we're going to look at some theory part today before we finish the other question, touching on shares, because I wanted to explain a few things that I want you guys to understand. Please, let's pay attention here, guys, because this thing is very important. And on Wednesday, we will be doing question papers from Wednesday going forward. I will be asking you questions regarding on what we're going to discuss now. So it's very important that you pay attention on what we are going to do here, please. And if you don't understand something, obviously, this is just a theory, but it's very important. You have to understand it for you to be able to understand what we're going to do going forward. Okay, we're talking about bookkeeping of companies. This is different from a sole trader, it's different from partnership. So we need to note those differences that we're going to discuss now. The first thing that we're going to talk about is what? The issuing of shares, right? We're going to talk about the issuing of shares at an issue price. What is an issuing of shares? For me, I can say that's why we're just selling shares. Like the terminology that we're using here to say we're issuing shares yes, we're calling it issue of shares, but this is like a sale of shares. We're selling shares to those shareholders, right? They're buying shares in the company and they will give us money and then we give them a portion of the company's shares. And then that's how we raise capital. Okay, what is the issuing of shares? It's an issue price. They're saying here, capital invested in a company by shareholders is known as what? Is known as share capital. So we need to know that there will be that capital that has to be invested by shareholders, and that capital is known as what? Is known as share capital, right? Whatever that shareholders are investing, some of them, they can invest asset and not the actual cash, but still that will be a share capital. And then they're saying here, the maximum number of shares a company may issue as described in its memorandum of incorporation is known as what? Is known as authorized share capital. We spoke about that before. I did touch on it to say the maximum number of shares that the company can issue as described in its memorandum of incorporation. This thing is stated in the memorandum of incorporation. It does say that how many shares the company is allowed to issue. As you can see in this question, what they were saying here. They told us Beaver Limited has an authorized share capital of 5,500,000 ordinary shares. It tells us that Beaver Limited is not allowed to issue more than 5.5 million shares. They are only authorized to issue 5,500,000 shares. We call that is the maximum number of shares a company may issue. That is authorized number of shares for authorized share capital. The number of shares, obviously, we talk about the number of shares, but when it comes to capital, we talk about the money that we raised from those shares that were issued. Okay. A company is not obliged to issue all the authorized share capital immediately. Yes, it's not a must. It's not like because I'm authorizing 5 million, now you have to issue them all at once. No, we can issue like 1 million at the same time, maybe in 1 year. We can issue 2 million in the following year. We can issue 3 million in the following year. So it's up to like, we need to check like whether there is a reason for us to issue those shares. We only issue the shares to the public only if there is a need. What are we doing when we issue shares? We're inviting the public to say, these are the shares that we have at the company. Can you please buy them so that we can raise capital? And then people, they will come and buy those shares. Whoever is interested, they will come and buy, and then they give us money, and then we give them their share certificates stating the number of shares they owning at the company, which means now they are part of the company. They owning a share in this company. Here we're talking about what? The issuing of shares. It's an issue price. They're saying here the share capital that the company issues is known as what? Issued share capital. Right, these are the terms, guys, we will be talking about going forward. That's why I wanted us to do these things so that I don't ask you about something that I didn't teach you. I don't want anyone who will say I've never heard of something like this when I start asking you about it. Please. That's the reason why I'm doing it myself. But I know it's something that you have already touched on at your school. Okay. The share capital that the company issues is known as what? Issued share capital. It is logical that the number of shares issued can never be more than the number of shares authorized. It can never be more than that. But I did say it before that we can issue more and then go and request the shareholders to authorize that. If we are only authorized to issue 5,500,000, which means I cannot issue 6 million shares. But when I see there's a need, we need money at the company, we're running out of cash, we have no capital, we have nothing, I can issue 6 million shares as a director. And then I'll go and ask the shareholder to say, this is the reason why I issued more than what you authorized. Can you please also authorize the extra shares that I've issued? If they allow, they're going to authorize it. But if they say, no, it doesn't make sense what you did, I may be liable to pay that money. That's how it works. For the director to be safe, you must stick on the number of shares that were authorized. Don't issue more than that. The Companies Act allows a director to issue more, but that's not something that we should be discussing in grade 12. What you need to know is that you cannot issue more than the shares that have been authorized. And it ends there. Steps in issuing the shares to the public. How do we issue shares? Very important that you understand how do you issue shares, because there are procedures that needs to be followed. It's not like Shoprite where I can go and buy bread and then come out. No, it doesn't work like that in companies. It does not work like that. So these are the steps that you need to follow to buy shares in any company that you would like to, or that you are interested to buy into. Number one, a prospectus is issued to the public with an application form to purchase the shares. So which means now you have to apply first before you can buy shares at Shoprite, before you can buy shares at Sasol, or whichever company you are interested to buying shares into. You have to apply, and then they will approve your application before you initiate the process. Before you can start buying the shares, you need to apply first, and they need to approve. Just like you going to the university, before you go to the university, you need to apply to be admitted at the university. Then once they admit you, then you will start studying. Then you have to register and do all other process. Then you are a student. Same thing when you're going to buy shares. What you need to do, you need to apply first. There is a prospectus that they will give you. What is a prospectus? Prospectus is a document that is giving you the information you need about an institution. The university will give you a prospectus as a student. If I want to apply to UKZN, they'll give me a prospectus so that I can see the qualifications that I'm qualifying for, that I can apply for. Same thing with the prospectus is of the company that is issued to the public. It tells the public more about the company. It provides more information about the company so that when I make a decision, I have to be comfortable. I don't have to blame anyone to say, I bought companies at Shoprite, but I was misled. No, you can't say that, because if they give you the prospectus, they're expecting you to go through it in detail, get all the information you need before you make a decision. If you make a decision that I'm buying these shares, it's up to you. If you lose, you lose. You don't have to blame anyone, because they provided you with a prospectus. So it's very important that you read the prospectus and understand it's more for giving you an information about the company. The company can only be liable to you if they provided false information in that prospectus. Then you can maybe hold them liable, like accountable for that. But if they give you information that is clear and straightforward and you made a decision, you cannot blame the company for that. Okay. The prospective shareholder completes the application form, enclosing the application monies as per the number of shares requested. Then now, after you have received an application form as a shareholder or a potential shareholder, you're going to obviously to complete that application form, and then you send it back with the money, right? Which means now I'm gonna send back the application form to the company that I want to buy shares on, and then after that, that application form must go with money to pay for the number of shares that I'm buying. And then if the applicant is successful, because the company will receive your application form together with cash, then if your application is successful, the company will issue a share certificate in the name of the shareholder, which means now, if we are giving you these shares as a shareholder, we are going to give you a share certificate. What is the share certificate? It means that now you are a shareholder, your application was successful. So that's how the company issue shares. That's how we issue shares to the public. That's how we issue shares to the public. Then now, shares that have been issued, how do you record them? Shares that have been issued, how do we record them? Because when I issue shares, I'm going to receive cash as a company. because we are the ones issuing shares, the company is issuing shares. So when we issue those shares, we are going to receive what? We are going to receive cash. And then when we're receiving cash, I'm going to debit bank, right? I'm going to debit bank, and then what am I going to credit? I'm going to credit ordinary share capital. Ordinary share capital, because I am issuing, I'm issuing shares as the company. So this is the journal entry that I'm expecting to process whenever we issuing shares. Debit bank, we're receiving cash, because when we receive that application form, it goes with cash, and that cash goes straight to our bank account. I have to debit the bank. Bank is an asset and it increase on the debit side. Ordinary share capital will be credited because that is an equity account and it increase on the credit side. Assets increase on the debit side, equity increase on a credit side. That's why I recorded transaction like this. Debit the bank and credit what? And credit ordinary share capital. But now, when there is a situation where all the shares that we issued to the public, we can also buy them back to the company. Because the reason why we issue shares is because we need money to operate as a company. But once we have generated enough cash for us to sustain the company, then we can buy back our shares that we have issued to the public. We can take them back, because we only issue shares if you need capital, if you need money for operations. Then you're going to operate, make profit, obviously. There will be a return on that investment and all of those things. Then we can buy back our shares, take our shares back and give the public their money. That is a process of buying back shares. So let's see, how do we buy back shares, and also the accounting part of that. When you're buying shares, how do you record that in the books of the company? Because now buying back shares is a reversal of this thing, right? Shares issued with debit bank and credit ordinary share capital. But now, when we're talking about share buyback, it's a reversal of what you can see there on top. So what am I going to debit? What am I going to credit if I'm buying back shares? What am I going to debit? What am I going to credit?
Do you credit retained income and debit ordinary share capital?
Why are you saying that?
Because for retained income, you have to take money from it, so it'll reduce.
Yes, come again.
For retained income, it will reduce because you have to use the share. You have to use the money to finance the shares.
Okay, you said I'm debiting retained income and credit what? Ordinary share capital, eh?
Yeah.
Okay, why am I crediting ordinary share capital?
I don't know, double entry. I mean, not double entry. Isn't it like the golden rule or something?
Yeah, no, I understand that part, Kinelo.
But I'm not entirely sure why I'm saying credits ordinary share capital.
Yeah, but I wanted us to make this thing simple. Let's not complicate it, né?
Okay.
You see under shares issued, what did we do there? We debited bank, right? Why we debited bank? Because we said we're receiving cash. Am I right on that?
Mm-hmm.
And then we credited ordinary share capital. Why we said that is because ordinary share capital is increasing because we issued shares and we're having cash in our bank account. So that is an equity account. It increases on the credit side. The capital is increasing. So that's why we credited ordinary share capital 50,000 because we issued shares. Now that we're buying them back, I told you it's an opposite of what we did. So is this journal an opposite of this?
No.
Please correct it then.
You will debit ordinary share capital and credit retained income.
Where is retained income entering here? Retained income
Oh,
is not
credit
here.
bank.
Exactly. Retained income is not here. I don't want to hear about them for now, but I understand where you're coming from. There will be a time where we're going to introduce retained income as part of this topic. But for now, shares issued, you debited bank, you credited ordinary share capital. Now that you're buying them back, you reverse what you did before. So I'm going to debit ordinary share capital, which means now ordinary share capital is decreasing. Am I right on that?
Yeah.
Ordinary share capital is decreasing, and then what am I going to credit? I'm going to credit bank.
Okay.
Why am I crediting bank?
Because you're using the money from the bank to get shares, buy back the shares.
Exactly. Cash is moving out of our bank account. When you're buying back those shares, we're going to buy it with the cash that is sitting in our bank account. So bank is an asset, but cash is decreasing in the bank. So which side are assets decreasing? Assets are decreasing on the credit side. Am I right?
Yes.
Yes. So this is the general entry that we're processing when we're buying back shares. For now, let me just say this is the general entry that we are processing. Let me not even say for now. This is a general entry that we are processing. The issue of retained income, I'll talk about it later. How does it enter here? But we don't just talk about retained income for no reason. If I bought shares for 50,000 and I'm buying them back at 50,000, retained income does not enter here. Right? Retained income does not enter in this situation. If I issued shares at 50,000 rand and I'm buying those shares back at 50,000 rand, there will never be a retained income in this transaction. We will never talk about retained income because I issued the shares at 50,000 and I'm buying them back at 50,000. The only time where retained income will be affected when I issued shares at 50,000 and I buy them back at 60,000, for example.
Okay.
That's when now I also need to credit retained income with a difference, right?
Yeah.
Which is going to be 10,000. Okay. And then I'm going to have 10,000 here. But this side, I'm going to have, let me just do it like this. Let me just do it like this. If I issued shares at 50,000, if I issued shares, oh, sorry, no, I'm not crediting. I'm sorry about this. We're not supposed to credit. We're supposed to debit it. So retained income should be here. Sorry about this. Retained income should be here as what? As 10. As 10,000. And then here we're supposed to have what? 50,000, and then in the bank 60,000 rand. Only, you see now the difference between the two. We're only doing this if we're buying back shares at a price higher than what we issued for at. I issued shares at 50,000, but I'm buying them back at 60,000 rands. Then I'll take ordinary share capital, I will debit it as 50,000, then the difference will go to retained income. That is the only time where you will see retained income as part of the topic. But if I do this thing as 50,000, there will no retained income in this situation. Okay, let's carry on. Does it make sense now? Eh?
Yeah.
Okay, perfect. Let's carry on for now. Buying back of shares. A share buyback is the purchase by a company of its own shares in the market. When they're saying in the market, we're talking about the shares that are sitting with shareholders, right? Shares that were issued before and they are sitting with shareholders. We go to shareholders and say, give us back our shares. Then we buy those shares from them. That is the reason most of the time. That's why we most of the time we're buying them at a price higher than what we issued for, because the shareholders wants to make profit. If we issue to them at 50,000, which means they bought those shares from us at 50,000. But now when they're selling them back to us, because they want to make profits, they will sell them at a higher price. That's where retained income is affected. Okay, this is done in order to reduce the number of shares on the markets. That is the reason why we buy back shares. A buyback allows companies to invest in themselves. By reducing the number of shares outstanding on the market, buybacks increases the proportion of shares as company owns. So here, what happens here? It's good to issue shares as a company, right? For us, it is good for us as a company. But for shareholders that we already have, it is not good. Because if we have 4 shareholders, all of them, if we have shareholder 1, shareholder 2, and we have shareholder 3, and we have shareholder 4. If we have 4 shareholders, all of them, they may be holding 25%. Each of them. Each of them, they're holding 25%. This is 100%, right, in total. This is going to be 100% in total. But now, if we issue more shares, which means we're adding 1 more shareholder, which means now there will be 5 shareholders, and then which means they will now have to hold 20% each of them. Because if I add shareholder 5 now, to say we issuing shares to this shareholder 5, so what's going to happen now? It is going to decrease the shareholding of these 4, and they will not be happy about that. Because if I'm holding 25% of the company, 1 person is entering here, then my percentage share will go down. Then I'm not happy. Then I'm not happy as a shareholder. So which means now all of them, they will need to have 20% now. You see, that's why they will not be happy. The other shareholders, that's why they will not be happy. And then in total, this will be 100,000. Okay, let's go back. Buyback can be carried out in 2 ways. Shareholders may be presented with a tender offer, whereby they have option to submit or tender a portion of or all of their shares within a certain time frame at a premium to the current market value. This premium compensates investors for tendering their shares rather than holding them back. That's why, that's why we usually buy them back at a higher price than what we purchased it for, what we issued at, because we're trying to encourage them to sell those shares back to us. That is the reason why we buy back shares at a higher price. Companies buy back shares on the open market over an extended period of time. That's another part of like how we buy back the shares over an extended period of time. What do we mean by that? Over an extended period of time, we're saying that if we bought our shares at a short period of time now, we are going to be considerate to those shareholders, because obviously they will have to make decisions on whether they're releasing those shares or not. If they decide to release the shares, we're going to buy them. But if they don't, if they decide otherwise, then there's no way they can sell those shares to us. It is always advisable that the company offer to buy those shares at a higher price. Then it will be very easy for them to sell back those shares. Even myself, if I can go to Shoprite and buy shares at 50,000, and then I hold them, and then Shoprite tells me that they want those shares at 70,000, I will sell the shares to them because I'm making a profit. You see, that's how business works. I will make a profit, and then I'm happy about that. In terms of Companies Act 71 of 2008, share buybacks are governed by Section 46. What does Section 46 say? For the company to buy back shares, it's a good thing. But I said that it's not good for shareholders. But there's something else that the company may need to look at. We as the company, we need to check if we have enough cash to buy back the shares, right? We must always check that as directors of the company. If we're making a decision to buy back shares, we must always have enough cash to buy back those shares. Because we need to check the liquidity position of the company. We need to check the solvency and liquidity position of the company. Why I'm saying that is because we don't want to find ourselves in a situation where we cannot pay our creditors immediately after buying back those shares.
So are you muted?
Hello guys, I'm sorry man, I don't know what happened with my network. Can you hear me on your side?
Yes.
I'm sorry about
Yeah.
that. I'm sorry about that. I think my network was kicking me out here. Okay, let's carry on then. What I'm trying to say is that I want us to talk about this Companies Act part. You see, guys, even you yourself, right? When you're deciding on buying something, you must know your situation. Would okay, I want to buy this, but now do I have enough money for me to buy this? Am I going to, if let's say, for example, I will just make an example. Let's say you are working and you're getting paid this salary, maybe 50,000, right? If you're getting a salary of 50,000 in a month, then when I decide to go and buy a cell phone of 50,000, I'm just making an example. Let's say there's an iPhone of 50,000 rand. You take the whole salary, you go and buy the cell phone. That's not a good decision. Like, that's a very poor decision for you to take. How are you going to survive the whole month if you take all the money you have, you take it and buy the cell phone? And then now you cannot survive, you cannot buy food, you cannot have transport to go to work, and you can't buy petrol and all those things. Same thing here. We as a company, we cannot take all the money that we have and we go and buy back the shares. How is the company going to operate after that if we take all the money that we have? It's impossible. We cannot do that as directors. We only buy back shares if we have enough cash. And even after buying the shares, we are still going to have enough cash to survive as the company. We can still be able to pay our creditors on time. We can still be able to buy the stock if we need to buy the stock. You see, those things are very important. That's why they're saying here, in terms of Companies Act number 71 of 2008, share buybacks are governed by section 46 thereof, which sets out circumstances in which a company's board of directors may authorize the share buyback, right? The company's board of directors cannot just authorize a share buyback unless they have carefully considered the solvency and liquidity test of the company. Look what they're saying here. The most noteworthy requirement is that buybacks may not be made unless the company will satisfy the solvency and liquidity test immediately following the buyback. So which means now immediately after buying back those shares, you must be able to pay your creditors if they want their money. You see? Same thing I'm saying to you. Immediately after buying your cell phone, you must be able to buy grocery if you need grocery. You must be able to have transport to go to work. You cannot just use all the money you have for things that are not necessary. Share buyback is not something that we can say a company cannot survive without buying back those shares. The company will, it's a luxury for the company. I can say it like that. It's a luxury. It's something where you have a choice. It's not like a company cannot survive if it doesn't buy back the shares. We can like postpone that thing if we see that we don't have enough cash as a company. While Companies Act 71 permits the acquisition of its own shares by a company, the JSE requirements include the following additional restriction. Specifically approved share buybacks are limited to 20% of the company's issued share capital, which means now you cannot buy back all the shares that you have issued. No, you can only buy back 20% of the shares that we have issued. That is the JSE requirement. But these things are not that much important for us at the moment. What is important is the accounting record entries to buy back the shares. This is what I was talking about here now. How do you record the share buyback? How do you record the share buyback? Let's see. Shares are issued to the public at different values per share. That's something that you need to understand. Number one, when we're issuing shares to the public, we always issue them at different prices. We always issue them at different prices because we issue shares in different days, in different times, in different prices. All amounts received for share issue is credited to ordinary share capital account. That's what I'm saying. All cash that is received is credited to ordinary share capital account. There is ordinary share capital account, there is credited. That's what they're talking about here. All amounts received for the share issue is credited to the ordinary share capital account. There is ordinary share capital account credited there. Right? Let me just remove the other scenario for now. I don't want us to see this for now, but I will show it. You see what they're saying? All amounts received for the share issue is credited to the ordinary share capital. They're talking about this David Bank and it credits the ordinary share capital. We understand that. I've already spoken about it. Share buybacks occur at amounts different from the issue price. You see? Share buybacks occur at amounts different from issue price of such shares, usually at prices above the original issue price, so that shareholders will be willing to release their shares. That is the reason why you end up finding out that now we need to have retained earnings, because most of the time we're buying back those shares at a higher price than what we issued for. If I issue the shares at 50,000, but I'm buying them at 60,000 rand, then that difference of 10,000 will go to retained income. That is the reason why we end up having retained income in this share buyback thing. Otherwise, there shouldn't be a retained income here. There shouldn't be a retained income, but we're only going to have retained income if you purchase those shares at a price higher than what you issued for. Okay, the following must be noted in respect of buyback prices per share. If shares are bought back at a price lower than the issue price, the ordinary share capital account will be debited with the total paid by the company for the share buyback. You see, if we just buy the shares at a price less than 50,000, we're just going to have this general entry. I'm just going to debit ordinary share capital for 40,000. Let's say we're buying them at 40,000 rand. I'm just going to debit ordinary share capital 40,000 and then bank 40,000 rand. You see, if shares are bought back and the price is lower than the issue price, the ordinary share capital account will be debited with the total paid by the company for the share buyback. If I only paid 40,000 rand, but I issued them at 50, but I buy them back at 40,000 rand, this is the journal entry that we're going to process. But let's look at the second scenario. If shares are bought back at prices higher than the issue price, now this is the problem here. This is where now we start discussing about what? This is now where we start talking about retained income. If the shares are bought back at prices higher than the issue price, the ordinary share capital cannot be debited with the total paid by the company for the share buyback. The recommended treatment is as follows. which means now I cannot, you see here, they're saying the ordinary share capital cannot be debited with the total paid by the company. If I'm paying 60,000, I cannot debit my ordinary share capital with 60,000 rand. No. But I'm going to have a negative ordinary share capital then if I do that. Because ordinary share capital was created by 50. If I debit it by 60,000, it's wrong now. I'm going to have a negative ordinary share capital. That's why we introduce a line by saying debit retained income, right? Debit retained income. Debit retained income. And then we're going to have 10,000 here. And then here I'm going to have 50,000. This can never go beyond 50,000 that we bought it for. That we issued at. It can never go above that. So let's look at the recommended. So they're saying recommended treatment is as follows. Debit ordinary share capital with one of the following amounts, right? The price at which shares that are being bought back were originally issued to the public times the number of shares bought back. So this is what we did here. This is the 50,000 that we just debited here. Or the weighted average price. We're going to work with the weighted average price because sometimes we cannot keep track of how much we sold the share, we issued the shares to the public. The questions, when they're setting the exams, they don't really tell you how much was the shares that we issued, that we're buying back, how much we issued them at. So we are going to calculate the weighted average price of all shares that have been issued to the public to date times the number of shares bought back. This topic will be covered in inventory valuation term 2. We're going to talk about inventory valuation, weighted average price. We're going to do that more there, but we have to do it here also. Buying back shares based on the first in, first out order of shares. This topic, this one, don't even think about it. They don't really do this thing on FIFO method. We don't do FIFO method on shares. No. We don't do. Usually what you're going to do here is the weighted average price that we're going to calculate. So that's what we're going to debit. So which means now ordinary share capital will be debited with the weighted average price. And then what am I going to debit? Debit retained income with the total amount paid above the value listed on the ordinary share capital account. Then that's when now I start debiting what? Debiting retained income with the difference, as you can see here. And then what am I going to credit? Then I credit the bank with the total. So we end up having 3 lines. So we only have 3-line journal entry only if we bought shares at a higher price. We bought them back at a higher price than what we issued at. That is the only time you're going to have what? That is the only time you're going to have a 3 lines journal entry. Do you guys understand this thing?
Yeah.
Please. This thing we're going to do in the ordinary share capital note, because this thing that you can see here will affect ordinary share capital note. This one will affect retained income note. If you buy back shares at a price higher than what you issued them at, retained income note is affected, ordinary share capital is affected. Whenever there's a share buyback, you must be careful. How much price are we buying them back at? Most of the time, it will always be higher than, because that is a complex situation. If you buy them back at 50,000, it's simple and straightforward. Same thing, you just reverse what you did before. If you're buying them at a price lower than that, it's simple and straightforward. But this is the complex one that they're going to test you on. They're going to test you on this one. So it's very important that we look at the same thing as what we were talking about this one. So I want us to go back and finish our question now. So here we have this transaction that we were doing the last time. Okay, as you can see here, these notes, guys, I have dividends to shareholders here. I'm still going to add more on these notes. I sent you this document already. You must check your emails. I sent this document. You must go through this document again and again and again. Understand it, print it if you have to print it, understand everything that is there, and then we're going to work on it at some point. On Friday when we did, not on Friday, yeah, on Friday when we did this note, we made a mistake here. I think we had 230 here, both sides. We had 230 here, which was the accumulated depreciation of vehicles. We're not supposed to have that. I think we made a mistake when we were typing here. We said accumulated depreciation on vehicles. We took this 230, and again, we took the 230 again for equipment. There's a video that I loaded on TikTok. You must look at that video. We used the same guys here, which was just a mistake. I corrected it. The accumulated depreciation for vehicles is 160 and equipment is 230. There is 160 and 230 here, which is something that I corrected it, and then we have 1,385,500. This is one of the mistakes I've noted. I don't know how many other mistakes that we did. And then I went to our fixed asset note. We have 1,385,500. Okay, and that was the only thing that I corrected so far. Nothing else. But what I want us to do now, I want us to do ordinary share capital note, and I want us to do the retained income note. These are the two notes that I want us to work on so that we can complete our balance sheet now. Our balance sheet, we only need share capital, retained income, and we need the trade and other payables as well. We needed to get the total somewhere here, of which we needed to get the total. We needed the shareholders for dividends that we needed to put here. And then probably this amount should come out here. We're gonna put it once we're done with the note. That's the only things we're going to look at now, and then we finalize everything there. Okay, let's see what they're saying here. They're saying the directors declared a final dividend of 20 cents per share, right? Final dividend of 20 cents per share. A total of 1,800,000 shares were in issue, right, on 31 March 2014, the last day of the financial year. Can you see now how many shares were in issue on the last day? How many shares were in issue on the last day? How many shares were in issue on the last day? So which means now I can go to my ordinary share capital note number 7, and say shares in issue at the end of the year. How many shares were in issue at the end of the year? They said there it's 1,800,000. So I can say 1,800,000 shares in issue at the end of the year, right? And then how much is the price of that? Okay, let's carry on. They're saying here 300,000 were issued during the financial year at £2, each. The issue of new shares has been properly recorded, right? The issue of new shares have been properly recorded. So what does that mean? It means that the amount that is sitting there is ordinary share capital. This is the ordinary share capital at the end of the year, because already the issue during the year has already been recorded. So I know very well that I have 2,800,000 rands here. Am I right on that? Do you guys agree with me? 2,800,000 that I'm going to have as what? As my share capital at the end. Then they said additional shares issued during the year. They gave us the number of shares that were issued during the year, which is 300,000 shares were issued during the year. So I'm going to have 300,000 shares. These are additional shares that were issued during the year. And then they said at £2. I think they said at £2. So if we issue 300,000 shares at £2 each, how much we're going to get? That is going to be 600,000 rands. But do we have any shares that were bought back? Nothing. Nothing was bought back. There is nothing. So I'm just going to have dash here. We didn't buy back anything because they didn't tell us about anything. So I'm going to have 0 here as well. Okay. Ordinary shares issued at the beginning. So how much would be our ordinary shares issued at the beginning, guys? In terms of the number of shares, let's talk about the number of shares first.
1.5 million.
It's going to be 1.5 million. 1,500,000 rands. Ordinary shares issued at the beginning. At how much? So how much would be the price, the value here? Here of 2,800,000. Sorry, not 2018. How much?
Would it be 2,200,000?
Yes, 2,200,000 because we're taking this 2.8 minus 600,000, then it's 2,200,000, né? It's going to be 2,200,000. So this is our ordinary share capital. We don't have a share buyback at this one, so it's not giving us a trouble. So, but most of the ones that we're going to be doing, obviously, when we're doing practice, they're going to have share buyback. So 2,800,000 will be our share capital. That's supposed to be here. 2,800,000 rands. Okay. And then we go back now, retained income. Retained income, there's the format. We're going to have a balance at the beginning of the year. We're going to have net profit after tax. And then there is share buyback also here in the retained income, even though we don't have share buyback. But let me just put it here. So we're going to have it at 0. So this share buyback that we can see here is this difference here that we usually take here. So if we had, it was going to be this 10,000 and I come and subtract it here. So that's why we're having share buyback, because we're saying there is one that affects retained income. Dividends. We have interim dividends and we have what? We have the final dividend, and then balance at the end of the year. How much are we going to have? So let's go back. Let's go back to our trial balance. They gave us retained income here at the beginning of the year. How much is this? 950,000 rands. So this will be my balance at the beginning, 950,000 rands. Can you see? They told us that it is the balance at the beginning because they gave us a date here. Retained income, 1 April 2013 is 950,000 rands. Okay. Net profit after tax. We did calculate it, how much we got as a net profit after tax. 697,025. 697,025. That is our profit after tax. 697,025. Okay. Share buyback, we always subtract it. It should always be in brackets, but in this scenario, we have 0 under share buyback. Then dividends on ordinary shares. Usually here we call it dividends on ordinary shares. So we need to state dividends on ordinary shares, not just dividends only. The format does not say that. Dividends on ordinary shares. We have interim, we have final. So the interim dividends, where do we get the interim dividends? Where do we get the interim dividends that were declared? Is it this one that is on the trial balance? Dividends on ordinary shares, 350,000. Can you see here? So this will be our interim dividend. Sometimes they will tell us in a transaction. So in this transaction, they didn't say anything about interim dividends. They told us about final dividends of 20 cents per share. But sometimes when we're doing the exam question papers, obviously, they are going to tell us how much interim dividends they were paid during the year. In this scenario, this is what we can see on the trial balance, 350,000 rands dividends on ordinary shares. We didn't take this into income statement. It doesn't go there. So I'm going to have my 350,000 rands here as what? As my interim dividends. Okay. 350,000 rands. Then the final or recommended. Sometimes interim dividends, it's interim or paid. Sometimes here, and then the final, we call it final dividends or recommended dividends. That's what we usually call it in our format. So the final dividends, they told us that the directors declared a final dividends of 20 cents per share. A total of 1.8 million shares were in issue on day 1 March. So how are we going to calculate the final dividends? How much you're going to get?
360,000.
360,000, very good. 360,000 because we're saying 1,800,000 multiplied by
0.20 or 20 over 100.
Yes, 1,800,000 multiplied by 20 cents, right? So which is going to be, I can say 0.20, yes, which is the 20 cents, okay? Then how much we're getting? 360, right? 360,000, and then, which means now my interim dividends is going to be this and these two amounts, and then getting how much? 710,000. Huh? 710,000. 710,000, right? Is that's what we're getting? Huh? Yes. Am I right on this one?
Yeah.
Okay. Thank you on that. And then now, how much would be our balance at the end? We're having 950 plus this one plus 0, and then minus the 710,000. Then we're getting 937,025. 937,025 rands. Am I right on am I correct on this one? So this is going to be our balance, 937,025, 937,025, which is going to be here, 937,025. Okay. Then we have 373,025 as part of what? As part of our share capital, shareholders equity. And then now, what is missing in our balance sheet? Trade and other payables. And on the trade and other payables, what we needed today, we needed the shareholders for dividends. And shareholders for dividends is what? Is how much? Shareholders for dividends, it will be the same as what? As the final or recommended. That will always be the shareholders for dividends. So we're going to have the same 360,000 will come to note number 9 as part something that we're owing. So we're going to have 360,000 rand. The shareholders for dividends, you must not forget, guys, that is dividends that we're owing at the end of the year, right? We only declared them and we didn't pay them. So they have to be part of our liabilities. So we have 360,000. So the total now for my trade and other payables, what we're owing is 582,475, right? 582,475. So that's what I'll go and record there. 582,475. Okay. 582,475. 47475. Okay. Then now we need to check if our balance sheet is balancing. Well, how much we have there? We have total assets 4,756,900, and then here we have 4,739,500. It doesn't balance. Somewhere, somehow, we made a mistake. Where did we make that mistake? Oh, we must not forget that. We spoke about those. You remember, guys, we spoke about these amounts here. We said these amounts, we are not really owing them, but they have to be part of what? They have to be part of, like, they have to be removed from the bank, from the cash, because these are the payments that were not made. They were not part of what? They were not part of our, like the employer contribute rent for rent. They said here, the accountant had, however, forgotten to complete the required posting to the general ledger. The general reviewed the following details. What we said here, we said these payments, most probably we made a payment, we paid them, right? But in terms of the accounting records, it's possible that they were not subtracted from our bank account. They were not subtracted here, even though they were paid when it comes to, the bank. They were paid, yes, but in terms of the accounting records, they were not taken into records because they are not part of what? They are not part of the journal. What they said here, the accountant had, however, forgotten to complete the required posting to the general ledger. Remember, when we're paying salaries, what we needed to do here, we needed to debit the salaries and credit the bank. So which means now for salaries, we did add them back here. We did add them, salaries and wages, we added 15,000, there is it, number one. And then we added 1,500 here, and then we added 800 here. So these are the amounts. So if we add all these amounts, we need to go and subtract them to the bank account. 15,000 plus 1,500 plus 800, how much are we getting? How much are we getting here? 15,000 rands plus 1,500 plus 800 rands.
17,300.
17,300 rands, which we need to come and subtract it from our cash and cash equivalents, where it was not subtracted. So I'm going to come here and say minus 17,300, okay, and 17,300. Okay, and then how much we going to get? So which means our cash and cash will change now here. How much you're going to get for cash and cash equivalents now? How much will be our cash and cash equivalents? How much you're getting as a total here, guys?
I'm getting to 2,805,650.
2,805,000.
Yeah.
2,805,000.
650.
805, 650, right? Like this, huh?
Yeah.
Okay. 2,805,000. But why is it going down, Kinel? Because we have 833 here. Is
Let me
it correct?
double check.
2,833,450. 2,500. I'm getting 282. 2,820,650.
I think I put something wrong here.
Yeah, 2,820,650. We're still off by 100 rand. I don't know where we left this 100 rand. Somewhere, somehow, from our calculators, and we're still off by 100 rand. But you guys can see the principle, the process. Somewhere, somehow, maybe from our income statement or wherever, there was a calculator error or typing error that we had. But you can see, like, our total asset is still different. Can you see that? They're still different
Yeah.
by 100 rand. So somewhere, somehow, we might have to check our calculator. 4,739,600, 4,739,500, or maybe it's the casting error or somehow on our balance sheet. But that's not a problem. But you guys can see the process of doing the balance sheets, né?
Yeah.
Yes, please. Always deal with your transactions. I'll send this spreadsheet to you. You can go through it again. Most probably you will see where we made an error in terms of our typing error or calculator, whatever. But what is more important here, you must always deal with transactions in both scenarios. Like when you're not sure of a transaction, you can leave it, but have a mindset to this most probably this is how we need to deal with the transaction. Just like this one, you know that we left it on that other day. We only added it on the salaries, but we didn't touch the bank because we said, okay, we will come back to it if we see that it gives us a problem. And you can see obviously here, it changed everything and we left with 100 rand. It was 17,000 something, it was 17,400. And then everything is fine now. Then we are sorted. Yeah, well, so please get guys, make sure that you follow the process of doing. Now we've dealt with income statement and the balance sheet at the same time, both of them. The only thing now that I'm going to do with you is to deal with the question paper going forward. We're going to practice the question paper, whether it's both income statement and balance